Putting integrity into finance, purely a positive phenomenon. Conclusion between analysts and firms. Capitalism and Society, Hutton's 2004 study, firms, audits, and analysts' spreadsheet earnings models result in the following of 421 responding to the NIRI 2001 study, 85.5% reviewed analysts' models. She labeled these guidance firms. These analysts showed more accurate forecasts to the sense of lower mean squared errors, but these analysts' forecasts were systematically downward biased, therefore yielding systematic positive earnings and surprises. Analysts of the no guidance firms walked down their estimated earnings in response to no negative earnings surprises, 47%, with 3 to 4 quarters of negative earnings news during the year. However, analysts of the guidance firms walked down their earnings estimates even though 49% of the firms have 3 to 4 quarters of positive earnings news. This walk down gives management a year-end boost and indicates a positive beginning of the year bias. Uh, The walk down practice is consistent with the hypothesis that these analysts ended up issuing forecasts that resulted in systematically positive earnings surprises so as to incur with the management team. If the hypothesis is correct, then in return for such positive earnings surprises, analysts receive favors from management that enable them to make more accurate, although biased forecasts. Matsumoto, 2002, see figure 4 below, a Bartov Givoli Hain 2002 document that managing earnings game seems to have arisen in the mid 1990s. They find that over the period of 1983 to 1993 to the period of 94 to 97, the proportion of negative end quarter earnings surprises fall from 48% to 31%. Positive end quarter earnings surprises increase from 40 to 50%. Zero earnings surprises increase from 12 to 19%. The upward bias on 1 quarter ahead forecast increased. A 3% premium return arose for meeting or beating analyst forecasts at the end of quarter. A small penalty for negative revisions of forecast during quarter arose. Figure 4, the managing earnings game seems to have arisen in the mid 1990s. You can zoom in if you want to see any of this. The peculiar equilibrium between analysts and firms. Analysts' long run 12-month ahead forecasts are systematically biased high. These forecasts are then walked down so that at the realization date, they are systematically low. See figure 5. In this situation, investors appear to get fooled by, in both cases, as indicated by the positivity bias forecast at the beginning of the period and the walk down of negatively biased forecasts at the end of the period. On the face of it, this seems highly inconsistent. One potential hypothesis to explain this inconsistency is that the analysts appear to be colluding with managers, to allow those managers to have the benefits of the excessively high long-term forecast while also allowing managers to meet and or beat the short-run forecasts at the end of the quarter, but it seems impossible for effective collusion to take place amongst so many players. Figure 5, analysts issue optimistic earnings forecasts, then walk down these estimates to a level firms can beat at official earnings announcement. Figure 5 is based on an aggregate of 1984 to 2001 data from Richardson, To, Wysocki, 2004, provided by the authors and shows the median difference of the forecast earnings per share and actual earnings per share scaled by the prior year share price. The sample consists of all of the individual analyst forecasts for firms with data on both the IBES and CompuStat and shows that the median consensus analyst forecast is initially positively biased, but the announcement, the median consensus forecast is negatively and statistically significantly biased. That is, the median company reports earnings slightly exceeding the year-end analyst forecast. The walk down results from management pressure and analyst self-selection. One explanation of this peculiar phenomenon is as follows. Suppose management imposes costs on analysts who are pessimistic or not sufficiently optimistic about the future results of the firm. Suppose such analysts opt out of reporting their bad news on companies without announcing why they opt out. Or perhaps they drop their coverage of the firm completely. McNichols and O'Brien, 1997, provide an intuitively appealing explanation of this hypothesis and present evidence that the observed phenomenon is due to analysts making systematically biased estimates, but rather due to analysts that self-select out reporting bad news on companies. If there is a range of analyst opinions about a company in a given month, and the analysts with the most negative opinions or information systematically choose not to offer a report, the resulting consensus opinion consisting of the analysts who actually report will be upward biased, even if reporting analyst is unbiased in his or her opinion. Analysts with a negative opinion with the negative opinions may well opt out of or delay issuing a recommendation until late in the period, may drop their coverage of the stock entirely to avoid the negative repercussions from management and others who are long the stock of company. It is well known, for example, that analysts seldom issue sell recommendations and infrequently delay issuance of reporting downgrading a firm. The fact that analysts seldom issue sell recommendations and often delay downgrades of the firm is consistent with the hypothesis that analysts with negative opinions delay issuing their forecasts or do not issue them at all to avoid offending management. The resulting consensus forecast is then biased upward. Consistent with this hypothesis, Skinner and Sloan, 2002, conclude analysts' long-run EPS forecasts are systematically over-optimistic for growth firms. This is systematically related to the inferior stock price performance of the growth firms. See also DeChow, Hutton, and Sloan, 1999 abstract, who conclude sell-side analysts' long-term growth forecasts are systematically over-optimistic around equity offering, and that analysts employed by the lead managers of the offerings make the most optimistic growth forecasts. Additionally, we find a positive relation between the fees paid to the affiliate analysts' employers and to the level of affiliate analysts' growth forecasts. We also document that post-offering underperformance is most pronounced for firms with the highest growth forecasts may be made by affiliated analysts. These facts are consistent with a system that is out of integrity and thereby destroys value. In this case, the managers that punish analysts who publish accurate but negative or less positive forecasts or recommendations are out of integrity because the actions of such managers are not consistent with the expectation, unexpressed request of holders of firm securities that management provide the market with accurate and unbiased financial reports on the firm's performance. More evidence that both managers and analysts manipulate earnings. Marcard and Weidman 2002 find that managers use accruals to manage earnings either up or down in situations to fit their own interests. At times of equity issues, firms use accruals to increase earnings and therefore the stock price. On the other hand, in the management buyout situations, firms use accruals to decrease earnings and therefore the stock price. The frequency of small quarterly profits is unusually large, and the frequency of small losses is unusually small. And so too far small, too for small And so two for small increases and decreases in profits, Bronxtaler and Dikshev, 1987. Managers change real operating decisions such as reducing research and development or advertising expenditures to meet benchmarks. See how DeHowe and Sloan, 1991, Boucher, 1998, Graham and Harvey, Rajgopal, 2005, and Raj Curry, 2004. Managers manipulate earnings upward around new equity offerings. Toe, Well, and Wong, 1998, Rangan, 1998, and Darrow and Rangan, 2005. Systematically overly optimistic analysts' long-term growth forecasts around equity offerings are associated with largest post-IPO underperformance for John Service, 1997. Myers and Skinner, 2005, found huge numbers of firms with consecutive strings of quarterly EPS non-decreases relative to the expected number. They find evidence consistent with the hypothesis that managers of simple sample firms take actions to, one, increase reported EPS when EPS would otherwise decline, and two, decrease reported EPS when EPS otherwise increase by more than the necessary to record an increase. Their evidence indicates this is done by strategically reporting special items, strategically timing stock repurchases, and exercising discretion over accounting for taxes to smooth changes in EPS. They conclude all CompuStat firms with at least 40 quarters of available data, 811 report earnings strings of at least 20 quarters. The corresponding expected number of firms varies between 28 and 71, again, depending on the assumed time series model generating quarterly earnings. In conclusion, we argue that the financial economics paradigm is incomplete. The evidence for any paradigm being incomplete is the presence of a significant continuing breakdown in the discipline, along with the discipline's continuing ineffectiveness in dealing with that breakdown, what Kuhn 1962-2012 termed crises and anomalies in a discipline. In the world of finance, the combination of, one, the extent of out of integrity behavior and its consequent impact on value, coupled with, two, the financial economics discipline having provided little or nothing that has been effective in stemming this out of integrity behavior, is evidence for our argument that the financial economics paradigm is incomplete. The out of integrity behavior we termed the scandals in section 2, and various examples of out of integrity discussed in sections 3 through 11, most often recognized as out of integrity behavior, are important examples of what contributes contributes to the general atmosphere of low integrity in the world of finance, albeit not identified as such and certainly not spoken of. Out of integrity behavior has become virtually institutionalized. The environment of low integrity is so pervasive, it seems to be nothing more than business as usual, or just a part of the nature of finance. Forrest Moser's 2006 first three indicators of lack of integrity listed in section 6B. Everyone else is doing it. We've always done it. And this is the way the business works. Illustrate this environment. When we speak of integrity in the case of a system or object, we mean nothing more than but nothing less than that the design, the implementation of the design, and the use of the system or object are whole, complete, unbroken, sound, and in perfect condition with respect to its intended purpose. When we speak of integrity for a person or another human entity, we mean nothing more but nothing less than the word as defined earlier of the person or human entity that is whole, complete, unbroken, sound, in perfect condition. We have shown integrity dealt with in this way is an important factor of production. However, integrity as it is currently understood has been undistinguished as a factor of production, with result that its impact on workability and therefore productivity and value by its present or absence by has been wrongfully assigned to other causes. Integrity as we define it matters not because it is virtuous, I love this, but because it creates workability, and workability increases the opportunity for performance, and maximum workability is necessary for realizing maximum value. Note that describing the effects of integrity is not normative. In addition, we make no admonition to act with integrity. It doesn't work to tell people what they should do. People act in what they perceive to be their self-interest, in the way it shows up for them, in the circumstances they are dealing with or confronted by. We don't tell people who what to do. Rather, we give a picture of reality. In this case, a picture of reality of integrity revealed as a positive phenomenon that naturally alters their correlated behavior. As the law of integrity states, as the integrity, the state of being whole, complete, etc., of an object, system, person, or human entity or practice declines, workability declines, and as workability declines, the opportunity for performance declines. Note, however, that when the behavior is not recognized as out of integrity, the decline of the opportunity for performance is explained in some other way. The model of integrity introduced in this paper is just as clear how widespread out of integrity actually is, and the enormity of the cost of out of integrity behavior. The model also makes clear. Oh, this is so much longer. Okay. We'll continue. Hope you're on the best ever. Peace, love. Bye bye. Mm-mm. There you go.